Is focusing on dividend stocks the wrong approach to investing? Consider this. In 1961, two economists named Franco Modigliani and Merton Miller introduced a theory to the world called the dividend irrelevance theory. And this theory basically states that a company's dividend, or the amount that it pays you just for owning the stock, has no long-term impact on the price per share. This is actually kind of a big deal. Dividends are really important to a lot of investors, and if they really are irrelevant to the price per share long-term, then it's possible that investors are actually just chasing the wrong thing. Okay, so were these economists, Modigliani and Miller, just a couple of idiots? No, not at all. These guys would actually go on to win Nobel Prizes for their works in economics. Modigliani won in 1985 for his work in savings and financial markets, and Miller won the Nobel Prize in 1990 for his pioneering work in the analysis of financial markets. So clearly, these two guys were very smart, they were not idiots, and yet they were saying that dividends were irrelevant. So in this video, we're actually going to look at more data that supports this irrelevancy theory, but more importantly, we're going to learn how to use this information to become better investors. And if you stick around to the end, I'll even share with you how I use this information to buy a stock that is going to yield me 3.8% when it's going to yield everyone else 1.3%. It'll make sense when we get there. Let's go. Hi, my name is Jon Quast. I'm really happy that you stumbled on my YouTube channel, Working Capital, because I have a hunch that you're willing to put in the hard work to improve your financial future, and I want to help you do that. And to help do that today, we're going to be reframing how investors should think about dividend stocks. So let's establish a baseline talking about the best and most reliable dividend stocks. I can really think of no better place to start than the dividend kings. These are companies that have paid dividends for at least 50 consecutive years. And not only that, they've raised the dividend every single year during that time. Among those, I looked at the top 10 longest tenured dividend kings. And what I found was, if you had reinvested all the dividends along the way, only 3 of these stocks were actually outperforming the market average over the last 10 years. Those 3 are American State Water, Parker Hannifin, and Cincinnati Financial. So in other words, if you had invested 10 years ago in the top 10 dividend kings, you had invested equal amounts in all 10. Over that 10-year span, you would have actually underperformed the market. It would have been better for you just to buy an S&P 500 index fund and reinvest those dividends along the way, and you would have had more money at the end of the 10 years. So even though these stocks were great for dividend income, they weren't necessarily great for building wealth. Now, I do want to caveat this. If you are in retirement or have maybe 10 years or less to go to retirement, maybe not everything I'm talking about in this video applies to you. And that's because different investors have different needs. If you are approaching retirement, you're probably not caring as much about beating the market. You're more concerned about preserving what you have built, and you're worried about income now. Now, if you have more than 10 years to go to retirement, you probably should be more concerned about building that. Now, here's why I say 10 years. Boston Consulting Group, or BCG, did a study of the top quartile of stocks, or the top 25% of the top performers of the stock market. And this study found that among these top stocks, 60% of the gains were driven by the growth of the business. By comparison, a company's dividend actually had very minimal impact on what happened to the stock price. Now, to be clear, this study was extremely comprehensive. It looked at the total shareholder return of all the companies in the S&P 500 over rolling 1, 3, 5, and 10-year periods from 1987 to 2005, which is almost a 20-year period. So based on this study, it would appear very safe to say that business growth is far more important to focus on than dividends for long-term investors. The takeaway from this point is that if you have more than 10 years to go until retirement, you should really be focused on outperforming the market. And investing in stocks for businesses that are growing is a more reliable way to outperform the market than solely fixating on dividend-paying stocks. So looking for market-beating stocks instead of looking for dividend stocks is how I stumbled upon one of my favorite companies right now. At the end of 2019, I looked at the top 10 stocks of the previous decade, and I found in the 10th place was a stock that I did not recognize, and it was called United Rentals. From the beginning of 2010 to the end of 2019, United Rentals was up about 1,600%. And this is a pretty boring business. It rents out equipment like backhoes or air compressors, really really depending on the job, but all sorts of stuff. And when I did a little bit of research on this company, I actually wound up investing in it because I thought it could beat the market. As it turns out, in the equipment rental space, 75% of the market is dominated by small players. That allows United Rentals to come in and acquire other companies at very cheap valuations. Now, the reason that it is actually good for United Rentals is it generates tons of free cash flow. It's a very good business, a very profitable business, and it's using that income to acquire other companies and grow the business. Also, this management team is very interested in rewarding shareholders. From 2014 to 2019, the management team actually bought back 29% of all the shares that there were, which increased the value of the shares for the remaining shareholders who didn't sell. So as I considered those things that had made United Rentals such a good company, a lot of free cash flow, acquiring other players in its space, and buying back a lot of stock with its excess cash flow, I thought, you know what, I believe that this dynamic can continue for the next 5 or even 10 years with United Rentals. So I bought the stock, and it has continued up until now. The company has made some big acquisitions recently of General Finance and Ahern Rentals, able to acquire these even public companies at very cheap valuations. And the stock has performed very well. Since I purchased shares, they're up 180% and actually my best performing stock over this time period. So now here's where it gets very interesting. Here in January 2023, the company for the very first time declared a dividend. The management team is committed to paying out $1.48 per share per quarter. With the stock price where it is as of this recording, that's about a 1.3% dividend yield, which isn't high yield. It's not a great dividend yield, but it is a nice start for this company considering it's the first time they've paid a dividend. However, since I was focused on market-beating growth, I've been in for a long time with United Rentals. Now for me, I am going to get that dividend too, but for my cost, I'm going to get a 3.8% return instead of the 1.3% return that anyone else buying the stock today for the dividend would get. So I hope that that makes sense what I'm saying here. My primary focus with United Rentals was the fact that can this stock beat the market over a long period of time, and I believed and I still believe that it can. However, since it's a very good business and it has now become a dividend stock, I'm actually being rewarded far more than I would have been had I purchased a dividend stock back in 2019 when I bought United Rentals. And so that's the point of this video. It is probably the wrong strategy to focus on dividend stocks up front if you have a very long time that you are going to be investing. It's better to focus on the growth of the business because that's what's going to lead to market-beating performance. Even better, sometimes the market-beating performance turns into a very good future dividend-paying stock, and it's actually going to pay you out better than if you had been investing in dividend stocks all along. Now, if you've made it all the way to the end of this video and now you are convinced that you should be looking for these dividend stocks before they're paying a dividend, you can go ahead and click on this video right here where I share how to do that, and even one in my own retirement portfolio. It's never paid a dividend, but I believe that it will in about 10 years. Anyways, thank you so much for watching this video. If this video helped you in any way, I would ask that you help me by giving it a like or commenting below on some ideas of your own, or even sharing this, subscribing, all of those things. Thank you so much for watching. We'll see you in the next video.